There is a moment in every cycle when the surface looks strong, but the structure underneath is becoming more fragile. That is where I believe we are now. The stock market is pushing back toward all-time highs. Asset prices are rising again. Bitcoin has been recovering. Home sales are showing signs of life in some places. People are beginning to feel that the danger has passed. But when I look at the machine underneath the surface, I do not see a simple recovery. I see a late cycle melt up and a melt. Up is one of the most emotionally dangerous phases in markets because it can make people feel rich before the real bill has been paid. That is why this moment matters. It is not just about whether the Federal Reserve cuts rates this month or next month. It is not just about one inflation report, one oil shock, one speech, or one headline. It is about the larger system of money, credit, inflation, asset prices, and human behavior moving together. Most people look at these things separately. They see oil prices over here. They see inflation over there. They see the stock market going up. They see consumer sentiment going down. They see Bitcoin bouncing. They see housing weakening in some regions and holding up in others. Then they try to make a simple conclusion. Markets are strong, so everything is fine, or consumers feel terrible, so everything must collapse. Both conclusions are too simple. In reality, when you study cycles, you learn that the world often moves in contradictions. Wall Street can be pricing in tomorrow while Main Street is struggling with today. Asset owners can become richer while wage earners feel poorer. Stocks can melt up while confidence breaks down. Inflation can be too high for rate cuts while markets keep rising anyway. That is not a contradiction to ignore. That is the signal. The first thing to understand is why the Federal Reserve has become trapped. Again, oil is not just another commodity. It is one of the central inputs into the modern economic machine. It moves cars, trucks, ships, aircraft, farming equipment, factories, plastics, fertilizers, packaging, and almost every link in the supply chain that brings goods from producers to consumers. When oil rises sharply, the pressure does not stay inside the energy market. It moves through the entire system. Transportation costs rise, production costs rise, fertilizer and food costs rise, shipping costs rise, packaging costs rise. Then the consumer sees it at the gas pump, at the grocery store, in airline tickets, in delivery costs, and in the price of almost everything they buy. That is why oil shocks matter so much. They are not isolated price changes. They are transmission mechanisms in the framework I use. You always need to ask how a shock moves through the system. A $10 increase in crude oil can add pressure to inflation and reduce growth. If oil moves from the high 50s to above 100, the effects begin to spread into the inflation numbers with a lag. People often look at the current inflation report and assume it describes the present. It does not. It describes what has already flowed through the system. If the oil shock happened after the measured period, the next report can look worse, not better. That is the problem the Federal Reserve faces. Inflation had already moved back to a level that was too high for comfort, and oil pressure makes it harder to argue that the danger is over. So the market went from expecting rate cuts to pricing in a much longer pause. The idea of quick easing disappeared. The rate cut that many investors expected this year was pushed far into the future. That changes the equation. It means the Fed is telling investors something very simple. We cannot rescue you yet. But the market is behaving as if it does not need rescuing. That is the part that people find so confusing. Stocks have rallied hard. A move of roughly 10% in a very short period is not normal behavior. A shift from deeply oversold to overbought in days is not normal behavior. A long winning streak in the Nasdaq is not normal behavior. These are the kinds of moves that happen when liquidity, positioning, fear, and forced re-entry collide. And that is why I call this a melt-up risk. A melt-up is not healthy confidence. It is not the same as a durable, balanced expansion. A melt-up is what happens when people who were defensive suddenly feel underinvested, when bears have to cover, when institutions chase performance, when investors who sold for safety begin to panic in the opposite direction. The first panic is fear of losing money. The second panic is fear of being left behind. Both are dangerous. What makes this particular market even more unusual is the gap between asset prices and consumer sentiment. Stocks are near highs, but consumer sentiment is near historic lows. That sounds irrational until you understand what each one is measuring. The stock market is forward-looking. It is trying to discount future earnings, future policy, future productivity, future margins, future growth, and future liquidity. Consumer sentiment is present tense. It measures how people feel when they buy groceries, fill up the car, look at rent, pay insurance, worry about layoffs, or try to buy a house. Those are two different worlds. Wall Street is betting on tomorrow. Main Street is living through today. And when those two worlds separate too far, you have to pay close attention. It does not automatically mean the market must crash. In fact, historically, very poor sentiment has often been a good long-term entry point because the worst emotional moments often occur closer to the best prices than the best emotional moments do. That is one of the great ironies of markets. The market feels most dangerous when the opportunity is often improving. It feels safest when risk is often highest. But you still have to be careful. You cannot simply say bad sentiment equals buy. You need to understand the system. You need to understand whether earnings, liquidity, inflation, interest rates, credit, and positioning support the move. Right now, I would not describe this as a clean environment. I would describe it as an environment with competing forces. On one side, there is inflation pressure from energy. There is a Fed that cannot easily cut. There is a consumer who feels worse. There is a housing market that remains constrained by affordability. There is political transition at the Federal Reserve. On the other side, there is momentum. There is institutional money returning. There are investors who sold too early and are trying to get back in. There is still long-term belief in technology, artificial intelligence, and productivity growth. There is the simple reality that markets can rise even when the news feels bad. That last point is extremely important. If you learn nothing else from studying markets, learn this. The market does not owe you a move that matches your emotions. It can rise when you think it should fall. It can fall when you think everything is fine. It can punish the person who waits for clarity, because clarity usually arrives after the price has already moved. People who sold into fear and waited for the economy to look obvious missed one of the fastest rallies in years. That is how markets work. They do not wait for you to feel comfortable. They move when the balance of buyers and sellers changes. This is why I have always believed that most people should be very careful about trying to time major market turns. Timing requires being right about many things at once. You need to know the economy, you need to know policy, you need to know positioning, you need to know valuation, you need to know sentiment, you need to know how others will react to the same information, and you need to know the timing. Being directionally right but early can still cost you. Being correct about a risk but wrong about how markets price it can still cost you. Being intellectually right and financially wrong is very common. That is why process matters more than opinion. Now, Bitcoin is giving us another example of this same dynamic. In a month when stocks were rising sharply, Bitcoin was rising too. Institutional flows returned to Bitcoin ETFs. Large financial institutions continued building crypto products. Companies and funds continued accumulating at the same time. National debt kept rising, which pushed many investors to look for assets outside the traditional monetary system. Bitcoin had fallen hard from its peak. Many people declared that the move was finished. They said it was going lower. They said the institutions had failed to support it. They said the rally was over, then it bounced sharply. That is typical. The moment when everyone says an asset is dead is often the moment when the risk-reward begins to improve. But the opposite is also true. The moment when everyone says it can only go higher is often the moment when the risk increases. This is not because people are stupid, it is because people extrapolate. They take the most recent price action and project it into the future. When an asset falls, they imagine more falling. When it rises, they imagine more rising. This is one of the most persistent weaknesses in human decision making. The disciplined investor must see this in himself. That is the first step. You cannot control the cycle if you do not understand how the cycle moves through your own mind. Bitcoin remains volatile. It can fall hard, it can rise hard. It is not something I would put an entire financial life into, but as part of a broader portfolio. Some investors see it as an alternative hedge in a world where the debt is rising and confidence in fiat currency is not as clean as it once was. The principle is not to be all in or all out. The principle is to size risk properly. That same principle applies to housing. Housing is not one market. It is many markets. National averages hide the reality. A 0% national forecast does not mean every home goes nowhere. It means some markets rise, some fall, and the average looks flat. That distinction matters. The regions that saw the biggest run-ups often become the most vulnerable when affordability breaks. Parts of the Sunday Belt, some high-growth pandemic markets, and areas where inventory has increased can weaken. At the same time, certain northern and more affordable markets can hold up better or even rise because buyers migrate toward where the payment still works. The key variable is mortgage rates. Everything in housing eventually runs through the monthly payment. When rates rise, the same house becomes more expensive even if the sticker price does not move. When oil pushes inflation expectations higher, mortgage rates can stay elevated. That keeps buyers cautious and sellers under pressure. Some buyers are sitting on the sidelines. They see more inventory. They know that missing one listing does not mean missing the whole market. Sellers especially those who bought in the strongest years, are beginning to realize that the market is no longer as forgiving. Some properties are selling below their purchase price from the peak period. That is not happening everywhere, but it is happening enough to matter. In housing, the cycle is slower than in stocks. Stocks reprice in seconds, Bitcoin reprices in minutes, housing reprices in quarters and years, but the same principles apply. Price is set by affordability, credit, psychology, supply, and time. When affordability is strained and supply rises, the seller loses some power. When rates eventually fall, purchasing power improves, but not always enough to solve the affordability problem. A moderate decline in mortgage rates may help, but it does not turn an unaffordable market into an affordable one overnight. That is why I would be careful about simple statements like housing must crash or housing must boom. The answer depends on location, supply, household income, mortgage rates, migration, and local job markets. Again, think in systems, not headlines. Now, the Federal Reserve transition creates another layer of uncertainty. Jerome Powell is approaching the end of his term as chair, and the expectation is that Kevin Warsh may take his place. Warsh has spoken about independence, about the need for unclouded decision-making, and about the importance of acting in the national interest. That is what a central banker is supposed to say. But markets do not only listen to words, they wait for actions. If a new chair comes in during a period of inflation pressure, oil stress, expensive assets, and fragile consumers, his decisions matter. If he wants lower rates, that could support assets. If he wants to shrink the balance sheet or reduce monetary support, that could create pressure. And historically, new Fed chairs often face market tests. The market tests whether they will rescue it. It tests whether they will tolerate pain. It tests whether they are independent. It tests whether they understand the cycle. But I do not think the wise investor should build an entire strategy around one person. The chair matters. But the system matters more. Inflation matters, credit matters, employment matters, the bond market matters, liquidity matters, politics matters, global capital flows matter. One person can influence the path, but one person does not repeal the cycle. That is why I keep coming back to consistency every time people think they have the market figured out. Something changes, a speech changes, a tweet changes, a war changes, oil changes, inflation changes, a bank changes its forecast, a company reports earnings, a politician says something, the entire short-term map shifts. If your entire strategy depends on predicting each of those things correctly, your strategy is fragile. A better approach for most people is to decide what they can invest consistently. Choose an allocation they can live with, even through a 30 to 50% drawdown, and keep going. That sounds boring. But boring is often what survives. If you only invest when the world feels safe, you will usually buy expensive. If you only invest after the bad news is resolved, the market may have already moved. If you sell every time the world feels dangerous, you teach yourself to exit near pain and re-enter near comfort. That is how many people underperform the assets they own. They do not lose because they own bad assets. They lose because they behave badly around them. This is one of the most important principles in investing. The asset matters, but the behavior around the asset often matters more. A person who owns a simple, diversified portfolio and keeps buying through fear can beat a person who has brilliant opinions but no discipline. A person who sizes Bitcoin at a level he can emotionally tolerate may do better than a person who goes all in, panics after a 30% drop, and sells. A person who studies housing affordability before buying may do better than a person who rushes because everyone else is doing it. A person who understands oil as a system input may understand why the Fed cannot cut even when markets want it. The world is not simple, but the process can be simple. First, understand the machine. Second, understand your role in the machine. Third, build a plan that does not require you to predict every turn. The market right now is telling us that liquidity and risk appetite are strong. The consumer is telling us that life on the ground still feels strained. The Fed is telling us that inflation is not defeated. Oil is telling us that the supply shock has not fully worked through the system. Bitcoin is telling us that alternative assets still have institutional demand. Housing is telling us that affordability is a real constraint. The Fed transition is telling us that policy uncertainty is increasing. All of those can be true at the same time. And when many truths conflict, the worst thing you can do is act as if one headline explains everything. This is the kind of environment where people get pulled into extreme views. The bulls say nothing matters. Assets only go up. The bears say everything is broken, sell everything. Both sides can sound intelligent. Both sides can use facts. But the truth is usually more balanced. Assets can melt up before they correct. Inflation can stay sticky while stocks rise. Housing can weaken in one region and strengthen in another. Bitcoin can be volatile and still play a role. The Fed can pause cuts and still not be tightening aggressively enough to destroy all risk appetite. A new chair can change sentiment without changing the whole system overnight. That is why I prefer to think in probabilities, not certainties. I do not know whether the next 10% move in the stock market is up or down. I do not know whether Bitcoin retests its high soon or has another large drawdown first. I do not know whether the national housing market is flat down or slightly up over the next year. I do not know whether the Fed cuts sooner or later than the market currently believes, but I do know this. The person who has no plan will be controlled by the next headline. The person who has no cash flow will be forced to sell when he does not want to. The person who has no diversification will be emotionally tied to one outcome. The person who has no discipline will confuse volatility with information. And the person who has a durable plan can use volatility instead of being used by it. So what should you do? You should not panic because the Fed did not cut. You should not become euphoric because the market rallied. You should not assume that a low consumer sentiment reading means the market must collapse. You should not assume that a melt-up means risk is gone. You should not chase every asset that has gone up. You should not abandon long-term investing because the short-term picture is confusing. You should build a plan that matches your time horizon and your emotional capacity. If you are investing for decades, then the question is not whether the market is overbought this week. The question is whether you are steadily acquiring productive assets over time. If you are adding to the same durable allocation every month, you do not need to know exactly what Jerome Powell or Kevin Warsh will say next. If you are buying Bitcoin, you need to know that it can fall violently and still be part of a long-term thesis if that would cause you to panic. Your position is too large. If you are buying a house, you need to understand the monthly payment, the local inventory, the local job market, and the risk that prices do not appreciate quickly. You should not buy because you think rates will save you. You should buy because the numbers work. If you are holding cash, understand that cash has a purpose, but it also has a cost. Cash gives optionality. Cash protects you from forced selling, but cash held forever in an inflationary environment loses purchasing power. If you are investing in stocks, understand that the market can move far ahead of the economy. That is normal. It is also normal for the market to overdo it. You need to be able to live with both. The bigger lesson is that markets are not there to make you comfortable. They are there to transfer money from the impatient to the disciplined, from the emotional to the systematic, from those who need certainty to those who can operate with probabilities. I have seen this pattern again and again. People wait for certainty, then certainty comes and the price is gone. People wait for lower prices, then prices fall, and they become too afraid to buy. People say they are long-term investors. Then a short-term loss tests them, and they discover they were really momentum followers. People say they want opportunity. Then opportunity arrives dressed as uncertainty, and they reject it. That is human nature. The job of an investor is not to eliminate human nature. It is to build systems that protect you from your worst instincts. This is why I believe the same message applies now more than ever. Choose your allocation, understand the drawdown you can tolerate. Keep a reasonable reserve, buy consistently, do not overconcentrate. Do not let headlines become your portfolio manager. Study the mechanics, but do not mistake constant analysis for intelligent action. The market has already shown how quickly it can punish those who wait for clarity. It fell hard, then rallied hard. Many people sold into fear and watched the rally happen without them. Many people waited for Bitcoin to fall further and missed the rebound. Many buyers in housing waited for rates to fall meaningfully. And the payment still did not improve enough. That does not mean every asset is a buy at any price. It means the world will not arrange itself neatly around your comfort. This is why process is more valuable than prediction. If this is a melt-up, the disciplined investor does not need to chase it with blind leverage. He participates according to his plan. If it reverses, he has liquidity, time, and emotional preparedness. If it keeps going, he is not sitting entirely outside the system waiting for a perfect entry that never comes. The goal is not to be the person who perfectly calls every top and bottom. The goal is to be the person who survives every cycle and compounds through it. That is the real advantage. The Fed may not cut for a long time. Oil may keep inflation sticky, the market may keep rising anyway, consumer sentiment may remain weak, Bitcoin may remain volatile, housing may stay divided by region, a new Fed chair may change the tone, or he may be forced by the same constraints as the last chair. All of those things are possible, but none of them change the core principle. You need a plan that does not require certainty. The people who win over long periods are not the people who react fastest to every headline. They are the people who understand the system, respect the risks, stay flexible, and keep compounding. That is how you come out ahead. Not by pretending the world is safe, not by pretending the world is ending, but by recognizing that cycles keep turning, humans keep overreacting, and disciplined capital keeps finding a way to move from fear to opportunity. That is the lesson of this market. And if this is the beginning of the great melt, remember what that means. It can make asset owners feel richer, it can pull people back into risk, it can make caution look foolish, it can make bears look wrong, it can make the economy look better than it feels, but it can also be the last emotional phase before the system demands payment again. So participate if your plan says participate, protect yourself. If your risk says protect yourself, keep investing if your time horizon is long. Do not chase like a gambler, do not hide like a frightened saver. And do not confuse price movement with wisdom. The market can move higher without being safe. The economy can feel bad without being uninvestable. The Fed can pause without killing the rally. Oil can pressure inflation without ending the cycle immediately. The only durable advantage is understanding these relationships before they become obvious to everyone else. That is what separates a disciplined investor from a reactive one. And in a world where one headline can change the mood in an afternoon, discipline may be the most valuable asset you own.